Good afternoon. My name is Michael Bell. I am the president of Harvard Business Services, and I have with me today Jarrod Melson, our general counsel, and Brett Melson, our vice president of sales. And today we're going to be talking about a very, very new act that was recently just passed called the Corporate Transparency Act. This is a very cumbersome and still very new act that has been put into place, and Jarrod has educated himself on this process and is going to walk us through it, and we're going to learn a little bit more about it all together today. So I'm going to get started here with our slideshow. All right. So we are Harvard Business Services. We were founded in 1981. We actually just celebrated our 40th anniversary yesterday. So we are now 40 years old. What a family, great family business, and great to be in business for 40 years. We're family owned and operated, headquartered here in Lewis, Delaware. Formed over 225,000 companies and have over 100,000 current clients worldwide. We are the specialist in Delaware registered agent information services. This is all we do all day, every day. We're customer focused. We are not attorneys, nor are we accountants. So anything that we discuss here is not to be taken as legal or accounting advice. And we have no affiliation with Harvard University. As you can see here, I do have a question box down here in the right-hand corner. If you have any questions throughout the broadcast, you are welcome to present them to us, and we will get to them as quickly as we can during the broadcast and after the broadcast. I also want to let you know that this broadcast is being recorded, so you'll get a recording of it within 24 hours to your email, so you can watch it at your leisure for those that are attending and those that are not able to attend. And we'll also put it up on our YouTube channel, and we'll also put it up on our website with the articles that Jarrod has written about this act that we have up. So, all right, you can't hear anything. Great. I've done this too many times, fellas.
It said to hit *1. Someone says they can hear. I can hear them.
Okay, can you hear me now? Thank you. Okay, perfect. So I don't know if I need to restart our introduction, but I will. My name is Michael Bell. I'm the president of Harvard Business Services, and I have Jarrod Melson and Brett Melson with me, and we're going to be talking about the Corporate Transparency Act. A little bit about Harvard. We were founded in 1981. We just celebrated our 40th anniversary yesterday. We're family owned and operated, headquartered in Lewis, have formed over 225,000 companies and have over 100,000 current clients worldwide. Delaware registered agent information specialists. We are not attorneys nor accountants, so this what we tell you in this webinar is not to be taken as legal or accounting advice, and we have no affiliation with Harvard University. With that being said, I'm going to turn it over to Jarrod, and he's going to take you guys through our webinar.
Good afternoon, everyone. Thank you for joining us. As Mike mentioned, I'm Jarrod Melson, the General Counsel here at Harvard Business Services. I'm joined here by Brett Melson, our Vice President of Sales.
Hello, everyone.
So, as an initial matter, you're going to hear a lot about the Corporate Transparency Act for the coming years. And as an initial matter, what does it do? What is all the hubbub about? The Corporate Transparency Act is a sea change in business formation in the U.S. It requires, unless exempt, virtually all U.S. LLCs and corporations, as well as certain non-U.S. entities, to report on a non-public basis to the government their shareholders, members, or other equity holders, depending on what the entity is. They would have to file this not only on an initial basis, but also on an ongoing basis. So that's really, and as you can imagine, this is what is driving the discussion around this act. This is a fundamental change for U.S. business formation. For instance, here in Delaware, very little beneficial owner information was required to be collected to form a company. In addition, even less was required to be passed through the state. Now, the government could get that sort of information through a warrant, but the Corporate Transparency Act represents an attempt to provide government with a shortcut in order to go after what it perceived to be bad actors within the system, people who were using LLCs, corporations in the United States to conduct criminal activities, everything from drug dealing to human trafficking. If you can think of it, it's said that they're doing it through these entities. So an overview on the act itself. It became law on January 2nd, 2021. It was put into an annual defense appropriation bill. Now, this was a must-pass bill, meaning that to fund the military for the coming year, this bill had to be passed. The Corporate Transparency Act was made a part of this multi-thousand-page act, and so it almost snuck in under the radar. It passed simply because the broader bill, the National Defense Authorization Act, had to pass in order for our military and government to continue to operate. Now, President Trump vetoed what's called the NDAA, the National Defense Authorization Act, but Congress was able to override the veto, the only time that that a veto was overridden. And so the Corporate Transparency Act became law. Now, it's been proposed, of course, in one form or another with some varying terms and in varying forums for over a decade. There's been constant pressure on the states in the U.S. To collect greater and greater amounts of information to bring the U.S. in line with certain European jurisdictions and others. Ultimately, rather than a state-by-state solution, which was slowly moving forward as the states required more and more information, the Corporate Transparency Act represents a final federal solution, a federal uniform solution that applies to all the states and the entities created under all 50 states, territories, as well as tribal lands. Now, as I said, the stated purpose is to prevent abuse of shell companies for criminal purposes. The thought was that these companies were being used, they were abusing the anonymity that was afforded to persons forming companies in the United States to conceal their ownership of these companies and to engage in all sorts of illicit activities. Now, there are documented examples of this, of course: money laundering, terrorist financing, tax fraud, drug trafficking. But as we're going to discuss here, a key question becomes, is this fundamental change in business formation a tailored response to the issue, or is it overbroad? Now, there are roughly 2 million companies formed in the U.S. every year that, absent an exemption, would be subject to this law. Is the law tailored such that it meets the goal with the limited amount of disruption, cost, lost time, and just economic waste possible? I would argue no. I would argue that the law is drastically overbroad. But we'll certainly see that as we discuss it. One of the key features of the law is that you need to remember it's not in effect yet. The Department of Treasury, which is responsible for the for the implementation of this law has 1 year from its passage, 1 year from it becoming law, to issue regulations. Those regulations are going to define the various terms used in the law, which currently are very ambiguous. It's going to provide very necessary detail to fill in some of the holes in what isn't included in the Act. It could vary greatly, either expand or contract the scope of the law, the number of companies subject to the law, and the information that needs to be reported.
So what you're saying, Jarrod, is nothing's set in stone right now. This can, even though the act has been passed, it can change up until it goes into effect.
That's right. There's certain features that will stay the same that are put forward by the act as benchmarks. But within those benchmarks, there's a lot of interpretive room to interpret certain terms. For instance, interpreting the term substantial control in determining who's a beneficial owner. What does substantial control mean in this context? For instance, what does beneficial ownership even mean in this context? Is someone an owner of shares if they own membership or of interest, if they own a membership interest in one series of a series LLC? Or is a series LLC a separate entity, for instance? They don't address that anywhere in this. Will limited partnerships be included? Currently, it expressly only applies to LLCs and corporations. It also says, and similar entities. But we really don't know what that might mean, whether it means limited partnerships. And we'll discuss that here. Now, again, it's framed as a federal solution for a perceived state law gap in information. It was thought that the industrialized world was outpacing us in information we would collect, and that the U.S. was actually slipping into the status of a money laundering jurisdiction. Whether that's true or not is up for debate, but that was at least the sense of a number of members of Congress, a large number of advocacy groups, and others. For instance, in the text of the final bill, in the statement discussing its reasoning, it says most or all of the states do not require information about the beneficial owners of corporations, LLCs, or similar entities formed under that state's laws. That's not necessarily true. In all but less than 20 of the states, at present, some form of annual report was required for corporations and LLCs, which provided at least some of the beneficial owners and management persons that this law is now going to catch. So again, perhaps it makes sense from an efficiency standpoint to have a federal solution as opposed to a state-by-state solution, but a federal solution is often overbroad by its very nature. Now, there was a lot of discussion of this act and a lot of support and a lot of opposition. Many advocacy groups see this as filling a crucial hole in the U.S.'s criminal enforcement and civil enforcement and simply enforcement of its tax laws. The government certainly was in favor of it, but many business, legal, and compliance groups opposed the act. For instance, the American Bar Association. You can find 36 different industry groups that joined a letter written by the National Federation of Independent Business, and many others. So a number of high-profile groups were opposed to this act, just as there were high-profile groups and persons in favor of it.
Well, you can see why, because it's a lot of having to keep history and making sure that these companies are keeping up with filing this information. How is it going to be filed with taxes, or is it going to be, have its own due date? Is there going to be a fee to file this and things of that nature? So there's a lot of unanswered questions here.
It really just brings the complexity into it. There's so many rules and regulations that must be followed already. This is really just one huge overbearing type requirement that there's just still a lot of confusion about. So I'm excited to see your thoughts on the matter.
That's very true. There's so much left for the regulations to address. We here at Harvard will be following this act as we have before its passage, and providing further updates and webinars on its terms and such as it's being interpreted, as the regulations come out.
Because without these regulations, we're not necessarily going to have specific answers to questions. There's a lot of confusion, like you mentioned. Who's going to be? What's the definition of a beneficial owner?
Definitely. A lot of the very key terms are really, while there's some mile markers to determine sort of loosely what it might look like, the actual substance of the law is still very much up for grabs. And it will depend what the Treasury Department ultimately comes out with in its regulations. Now, with those regulations, the public will have an opportunity to comment on them through what's called the administrative law notice and comment process. Treasury will propose these regulations. There will be a period, 60 days to 90 days perhaps more, where the public can provide comments to these regulations. Those comments are addressed and reviewed, are often addressed specifically in the final adopting release, which adopts the final regulations. But there is still a lot of time for business input. There's a lot of time for people with an interest in this act to comment on it, both for, against, or for contracting or expanding its scope.
So what's the Act's stated purpose?
The stated purpose is to, combat these shell companies. It's to combat these companies that have no legitimate business purpose and really act to conceal the identity of the people behind them, and certainly to conceal their activities. It allows, supposedly in theory, and definitely in fact, but perhaps to a greater degree than Congress would want us to believe, it allows bad actors to get away with a great deal while remaining anonymous. And it is difficult to serve a warrant on these sorts of companies, particularly when you've got layers of entities owning other entities, often in offshore jurisdictions. But again, I don't know whether this act is actually going to catch any of that, because the fundamental premise is that this is intended to capture criminals. Criminals don't accurately file reports. It's very easy for them to get around this in the filing process, particularly when there might be 2 million filers, simply by submitting what looks like but actually is not accurate information. In terms of the effective date, you might be asking, when does this go into effect? When do I need to file this first report? Well, that's not even clear at this point. The final effective date, when this will go into effect, is subject to the regulations. When the regulations are finalized, that is the date when this obligation will come into effect, as we'll discuss very soon and when we discuss the timing of the reports. And so what are the next steps? So for instance, what should a company be doing now? Doing right what we're doing today, discussing the terms of the Act, begin reviewing the scope of the law as it stands, determine whether your company is a reporting company, what reports you might have to make, whether you qualify for an exemption, and even if your ownership base is kind of static, perhaps start to trace through entity owners, looking at the scope of the law now to make compliance later perhaps far easier, and to inform comments for when the regulations come out. Where are the sticking points? Where are the real difficulties in implementing this reporting regime when companies are really looking at the nuts and bolts? As I mentioned, we're going to continue issuing articles and providing insight. So continue looking at our blog and our webinars for future events where we discuss developments here. Now, I think we can get really into the nuts and bolts now. I've already said what does the Act require as a threshold matter. It requires reporting that was not required before of beneficial owners. Generally, a subject company, a company subject to the Act, must make an initial filing with FinCEN, which is a division of the Treasury Department, the Financial Crimes Enforcement Network. When a company is formed, at the time of or in connection with its formation, or at the time of or in connection with its registration to do business with a state or tribal area in the case of a non-U.S. entity. Now, we're going to talk about just who's covered by the Act next.
So that brings a question into play, and there's some ambiguity here. Right off the bat, we don't have a clear definition of when this must be filed. So you mentioned that it must be done in conjunction with the formation. However, is this a 30-day filing, a 60-day filing? So that's something that we're really going to want to have clarification on, especially for our industry and our clients with these new companies.
And are they going to have to do it multiple times a year? If you change ownership in the middle of the year, as most companies do, are you going to have to refile this?
That's a great point.
Yeah, I mean,
and then when will you have to refile it? If you've got an ownership change, when is that filing going to be required?
Yeah, I mean, currently it simply says, I believe the exact language is contemporaneously with formation, at the time of formation, or concurrently. And then in addition to this, as you mentioned, an amendment filing, you have to file within 1 year anytime your beneficial ownership changes. Now, this could result in a lot of filings. I mean, if your beneficial ownership changes twice a month and you're making filings, let's say, who knows how long we'll have. The regulations will tell you how long you have, to actually submit the filing and prepare it as of when, as of the date of the transfer, as of the, settlement date. But fundamentally, the question is, are you going to have to file 20 reports if your beneficial ownership changes 20 times in a given year? Currently, it would look like yes, but again, I believe the regulations are going to try to find ways to streamline this reporting. So, for instance, if a reporting company has 3 other reporting companies as its beneficial owners, you may simply be able to cross-reference those 3 owners' own filings in filling out the applicable entities' filings, a way to simply cross-reference or incorporate by reference other entities.
Now, we've mentioned this, and we hear this term quite often, is beneficial owner. I know we're going to be getting to that, but I know a lot of people right off the bat might just have questions about, what are you referring to as a beneficial owner?
Beneficial owner, in a general sense, refers to the real power to dispose of or make decisions with respect to shares or interests. It's not someone, for instance, a broker holding shares in street name, in the company's name that he works for, for instance, he or she works for. Street name is not beneficial ownership often. It's the underlying owner or whoever has the proper authority. But generally, it means getting down to the natural person, the individual that actually receives the benefit and has control over the shares or membership interests. And so you'll have to look through, a company who's subject to this act will have to look through various levels of intermediate entities that may hold its interests or shares.
So what you're referring to there when you say intermediate entities, you're talking about an LLC that may have another entity which is the member of that, which then in turn may have another entity that's the owner. So that's where the ambiguity and the complexity really comes into play. Complexity comes into play.
That's very right, and that's one of the key things that will be handled in the regulations. Is beneficial ownership is a fairly common concept in U.S. securities law, but it's one that is subject to a lot of different tweaked definitions, a lot of definitions that just work in different ways, and a lot of really bad definitions that seek to trace through these entities to find the actual person that benefits from and truly could be said to hold these shares or interests.
Great, thank you for that clarification.
Yeah, so we're not sure if it's going to be someone who has 25% of the company or more, or if it's 50% or more. It's a vast majority, or a vast, very strange.
Yeah, I mean, too, you got to think about it this way. I think from what I've read initially, it's one that owns 25% or more.
That's what I've heard in my days. Is majority ownership is it's 25% or more. Then you have to report K1s and things of that nature. But that's all well beyond my scope of expertise. But that's just what I've heard, but we'll just have to see what they come out with.
Definitely, and what happens, for instance, if an individual a natural person owns 55% of an LLC, which then owns 26% of the company that you're looking at for the filing. You know, technically that person has beneficial ownership over less than 25%, but it has beneficial ownership over a company with beneficial ownership of more than 25%. So that's how complex this is going to get. Let's switch briefly to sort of what companies are subject to the Act. Who has to worry about this? The definition of a subject company is extremely broad, but there are a number of exceptions, which carve out a number of companies from reporting, but not necessarily the ones one would think are logical or would expect. Who's subject to the Act? LLCs, corporations, and similar entities formed under the laws of a U.S. state or tribal area, or non-U.S. entities registered to do business in a U.S. state or tribal area. So even non-U.S. entities, say for instance, who are registered to do business in California or New York, and this is very common, as you know, would be subject to these rules. You wonder, are non-U.S. persons and entities who may want to avoid being on the radar of, say, the IRS or other U.S. regulators for perfectly legitimate purposes, going to be as willing to register to do business and actually do business in some U.S. states? This is going to apply to them just as onerously, and you wonder, are beneficial owners of these non-U.S. entities who may be 2 or 3 times reserved through intermediate holding entities, are they going to want to be subject to this requirement? And what's it going to do to sort of the cross-border trade, cross-border formation of entities, subsidiaries? It's going to be interesting. And so, as I mentioned, the scope is subject to exceptions. The biggest one, to my mind, is the large entity exception. This act is targeted at small companies. It's targeted at those that might be shell companies, the characteristics of companies that could be shell companies. Now, I would argue that the definition is far overbroad. The large entity exception says that a company is not subject to reporting if it has more than 20 full-time employees in the U.S., it's filed in the previous year tax returns that show $5 million or more in gross receipts or sales in the aggregate. That's including other entities owned by the entity at issue or other entities through which the entity itself operates. And the large entity has to have a physical office in the United States. So 20 full-time employees in the U.S., $5 million in gross receipts or sales in the previous year, filed with the United States, filed with the IRS, and it has a physical office in the U.S. Now, this exemption is going to be heavily subject to interpretation and explanation by the Treasury regulations. But this is a big one. I mean, this carves out a lot of larger companies and leaves the burden on companies that are small, that are startups, and that really are the least able to handle this kind of burden. They'll have to hire an attorney to actually trace through this kind of beneficial owner definition. And really all entities that are newly formed that are not subject to the next exemption, which talks about specific kind of regulated companies, are going to be subject to the Act. Pretty much any entity formed is not going to have more than 20 full-time employees in the U.S. at the time of its formation, $5 million in gross receipts in the past year because it didn't exist, and a physical office in the U.S., which may or may not apply.
So they would have to meet all 3 of those characteristics, not just one.
That's right.
So,
qualify.
for instance, if they had just 20 full-time employees but didn't meet the other. Interesting.
That's right. They're still subject to reporting. Again, this will be filled in quite a bit by the regulations.
Now, is there a time period you expect to go ahead and have the clarification or some of these answers filled in?
It does have to be at least the issued regulations, the proposed regulations that are subject to comment by the public have to be issued 1 year after the passage of this act. So the act passed on January 2nd. However, I have seen very large law firms, accounting firms, quoting different days, saying December 31st, 2020, January 1st, 2021, or January 2nd, 2021, or 2022. And
right
so
those couple days.
Yeah,
so.
it's somewhere in those 3 days, but I've seen, major law firms disagreeing on that point, or at least not knowing quite specifically how that works, because the act is vague fundamentally.
So is this act to try and prevent from these new businesses from getting to a certain point?
It's intended to hit those businesses that are really never going to become legitimate operating businesses, where they might have, let's say, 3 owners in the U.S. or some overseas, and those people are trafficking women from Europe, let's say, or they're shipping heroin from Afghanistan. It's meant to hit those kinds of companies, which is why I think it's so overbroad. Here, I believe I read there's 2 million companies a year formed. They're putting an initial burden on 2 million companies that are being formed in order to catch some very small, let's say 1% to less than 1% of companies that are formed in the U.S. for the purposes of crime, tax evasion, concealment. I mean, fundamentally, that's not who you're hitting with this burden. You're hitting everybody from the plumber that decides he's going to form a new plumbing business to someone with a really fascinating idea that wants to start a company, or even just an Amazon seller. You're really selling on a platform.
You really hit the nail on the head, and that right there is a huge portion of our new formations. It's not going to be a lot of companies that are going to have 20 plus employees. Primarily, it's the small guys, the plumbers, the Amazon resellers. How many different holding vehicles are we forming? LLCs, just to hold an asset. So it's a big net they're casting here.
It really is. It really is. And now there are going to be ways that they try to address those holding entities and who's subject to reporting. For instance, if all of your beneficial owners are themselves subject to reporting, it looks as though you won't have to report. You'll just have to make a report that references those other companies by their file number. Because each company also, as we're going to discuss, is going to get a new filing number they're going to have to apply for from FinCEN with a new reporting system.
This is a FinCEN file number.
That's right. This is something FinCEN is going to give everyone a unique numeric identifier. So in connection with the formation of a company, companies like ours are likely going to seek these numbers, these identifying numbers, and have to then make the filing in connection with the formation. So it's one more step. Yeah.
Completely different bureaucracy than obtaining the tax ID number, the EIN from the IRS.
And this filing, they have to obtain this FinCEN number after they get their EIN number, essentially.
Most likely. It's difficult to say. They haven't said whether or not they would issue that at the same time, for instance, because it's a Treasury Department filing as opposed to IRS. They could have a whole separate system.
Right.
They're going to have a whole separate filing system, and we know how well the government deals with constructing entire technological platforms in the span of less than a year. That's going to go well. But it's so it's really, it could be it sounds like a small thing, but as you gentlemen especially know, it could be very burdensome to have to go and get that at an extra step. And one of the benefits of forming in the U.S. is speed to market. You're able to get that entity up and running. And this is another roadblock in speed to market, where people are going to have to take additional time and give up additional privacy rights to operate a company in the United States.
Well, then what about these companies these small companies that have already been around that make less than $5 million a year and have been in business for 5 or 10 years now? Do they have to do this too?
They are going to have an obligation. The same as any other company, but except at the outset. At the outset, existing companies that exist at the time Treasury regulations become effective, at the time the law goes into effect, if they were in existence before that, they have to file their report within 2 years, their initial report within 2 years. And then after that, just like everyone else that's formed after that date, you have to file corrective amendment filings. And so really, not just new companies going forward, but virtually every company in existence that doesn't fall within the large company exception or the next exception I'm going to speak about are going to be subject to this. It's a massive number. It's millions of companies.
Okay, so with that being said, let's look at the entities that are kind of subject to extensive regulation here. I mean, we know that banks are heavily regulated and all of that. We know that federal state credit unions are. We know that investment companies under the Investment Company Act of 1940, along with investment advisors, a broker, a nonprofit is kind of an interesting conversation. We did have one person who provided us a question on that exact on nonprofits of how will this impact non-for-profit organizations.
It's very interesting because is a not-for-profit one of those? Are there times in which a not-for-profit entity may be subject to the act? It looks like they would not, because at least if they're described in 501c, 501c3, of course, is the largest nonprofit category, but things like charities, church groups, investment clubs, any of these could be nonprofits that would be excluded. But the Internal Revenue Code is so complex that I have no doubt there are a number of entities that may be nonprofits or that may be tax exempt that are going to have to report until they carve them out. These entities here, the ones that you just named, are subject to an extensive regulation and reporting already. And so they figured, these aren't the kinds of companies that are going to become shell companies that engage in prostitution and such. A mutual fund is just not in a place to file with the SEC and then also, pimp out modern day slaves, sadly. And so, these are already subject to a comprehensive reporting scheme, so they take them out of reporting under this act. And again, if your beneficial owners are all themselves exempt entities, you are exempt from the reporting. Interestingly, though, if you're exempt from reporting, you still have to make a filing that says why you're exempt as an initial matter. So if you're a bank or a large reporter, you have to make a filing which says, I'm a large reporting entity, I do not have to file. From there, I believe you're done, unless the regulations say otherwise in the future.
Unless you slip into where you're no longer considered a large reporter.
That's right. You have to make a filing if you become exempt, and then you have to begin to file if you were exempt and are no longer.
So no matter what the circumstance is, you're probably going to have to file something.
That's right. At least once, you're going to have to get your hands into this system. And now the question becomes, what persons must be reported? Who has to be spoken of in these reports? Beneficial owners are the word that they use, and we've talked about that. Now, here it implies two things, and they're not necessarily intuitive. One is someone that owns 25% or more of the equity interests of the subject company. So an LLC, shares of a corporation. The easiest example is a natural person directly in his or her own name holds shares of a corporation that's subject to reporting.
Now that brings up a good point.
26%, let's say.
So, for instance, a married couple, each owning 13%. Would they consider that as one individual? Would they come out with clarification there?
They likely would. In a lot of places in the securities laws, they do treat married couples or spousal equivalents. I'm not sure if spousal equivalents will apply given the Supreme Court's ruling on broad marriage rights for gay and lesbian individuals. But spousal equivalents, which itself is a problematic definition, are usually treated as one holder. But there's other questions in the same way. For instance, what if members of a single family, as part of a family office investment, 5 people hold shares? Are they one unit? Are they part of a? It's likely they would be, but it depends again what the regulations say. In addition to the 25% owner, there's also have to be reported anyone who exercises substantial control over the subject company. This would be your directors, your officers, C-level officers, for the most part. Again, directors, C-level officers, maybe the manager of an LLC, a managing member.
So even though they don't necessarily have the ownership, the beneficial ownership, since they are deemed a manager of that LLC, or even just that of a director of the corp, that information is reported as well. So this is well beyond even beneficial owners.
Yeah, they technically call these people beneficial owners. And interestingly, it is not just by title. It's any arrangement, understanding, contract, course of practice that gives the person substantial control. So you have to look not just at, say, the terms of a contract, but you have to look at the actual on-the-ground situation what's going on. Does someone with 15% nevertheless, as a founder of a company, still make the decisions effectively? They would have to be included, even though it's an understanding that's not written. It's just an arrangement that gives them substantial control, even if it's not contractual or title based. Now, substantial control. There's certain times that that people can be excluded. Beneficial owners exclude certain persons that I talk about here. A minor child, if a parent or guardian is reported. An individual acting as a nominee or custodian. So, for instance, a bank holding shares in custody for someone, for a brokerage account. They are not considered a beneficial owner. The individual whose interest is through a right of inheritance. So, for instance, if they're a beneficiary of a trust that holds a company, they don't necessarily become a beneficial owner simply because of that the inheritance rights that when the person, say the grantor dies, the business goes to the beneficiaries. That alone isn't enough at that point. Or even a creditor of a reporting person, unless the creditor would otherwise be a beneficial owner. So let's say there's somebody has a charging order out against a member of an LLC. They're able to step into that person's shoes and get the distributions that member would otherwise be entitled to. That creditor is not treated as a beneficial owner unless the creditor otherwise would be a beneficial owner. So you can see there's some exclusions, but it's going to be a very difficult process for Treasury to put out a definition of beneficial owner that's going to please anyone. And maybe that's the goal, is to please no one and therefore sort of split the baby. But it's going to be a lot of discussion around, particularly given the stakes, given the large economic and the large, broad stakes of reporting here. And even more than the economic rights, are simply the loss of privacy rights. This is going to be a real fight over beneficial ownership and the definition. Now then the question becomes, what must be reported about someone? Let's say we determine a person's a beneficial owner. What has to be reported? Full legal name, date of birth, current residential or business address, and a unique identifying number from one of a certain number of types of identification. For instance, a U.S. passport number, perhaps a U.S. driver's license number, a non-U.S. passport number may work in many cases. A non-U.S. ID card may work depending on the content and depending upon whether it's government endorsed. There's a lot, or simply a FinCEN identifier. Companies will be getting these identifiers, and that will be the identifying number for an entity. But again, you have to look through an entity to the ultimate beneficial owner of the person. So, an LLC owns your LLC. You have to look through that intermediate LLC to find the ultimate beneficial owner of the company being examined at issue.
Now, I do have a question there, Jarrod. You mentioned that it's an identifying number, a passport, a government ID. Now, are you going to be required to actually submit that type of ID, whether it's an ID from a gentleman or an individual from another country? Are you going to be required to submit accompanying documents?
Yes. Well, I'm not certain whether you'll actually have to be required to submit, say, a copy of the ID or just the number itself that allows the government then to look up the person holding that ID. That's the goal, is to capture an identification that a U.S. government agency or non-U.S. government agency that's able to have access to this information, as we discuss next, can they then attribute with confidence that identifier to that person? That's really the touchstone. So then we talk about how can the filed information be used, and this is really a key crux, because if you're forced to give up this information, at least you can take comfort in the fact that it's non-public. It is not a publicly reported database. It is not open to the public. It's intended to be particularly secure, and there are certain, security and information security is a huge concern here. I think the government tried to give some level of cold comfort by wrapping the law in extra cybersecurity language, but the U.S. government doesn't have the best track record of preventing intrusions.
So that's a great point. So this information is not publicly available. There's not a database. It's like that of the responsible party for the EIN number. Mm-hmm. That information is not able to be ascertained by the general public. You can't search it. So that will put many people at ease that it's just not out there for anybody and everybody to see. That could have drastic ramifications from a business standpoint.
Oh, yeah.
Good point.
But the fact that these are private companies, and given the way that the government is sort of a sieve of information, sadly, in a lot of ways, for those who intrude on technological networks, that's valuable information. These private companies that before had no obligation to document in any available way their ownership could now be found out by someone pulling this information. And I have no doubt that not long into the operation of this reporting network that there will be just such intrusions. I have no doubt in my mind that that's going to happen. And so who can access it then, if not the public? U.S. federal law enforcement.
Without a warrant.
That's correct. State and local law enforcement require a court order authorizing access. But it can be examined by U.S. federal law enforcement with a proper purpose, as it's stated, but without a warrant. A U.S. federal agency requesting access on behalf of non-U.S. law enforcement. So non-U.S. law enforcement could come to U.S. law enforcement, which would then make a request for the information on behalf of the non-U.S. law enforcement. Now, interestingly, too, one of the ways the information can be used is with the consent of the reporting parties, it can be given to banks for the purpose of their know your customer, anti-money laundering type obligations. One of the goals of the law, much smaller goal, was to take the know your customer, the KYC obligations, to some extent off the bank's back, the financial institution's back. So now the burden for finding beneficial ownership and for taking the burden of relying on reported beneficial ownership is no longer with the financial institution in, say, opening a bank account. It's with the reporting company, which then has the penalty of perjury and large civil and criminal penalties if they violate that, if they put false information.
The banking industry was all on board.
Oh, yes.
It makes their life that much easier.
Oh, yeah. It's going to cut their compliance costs. It's going to, I don't know if that'll materialize into greater benefits in terms of speed of opening bank accounts or whatnot. But, yeah, they were eager for this.
Now, I know a lot of our non-U.S. clients are always hesitant to give information to the government. And, right here with non-U.S. tax agencies, how are they going to be able to access this information?
That's a good question. It's primarily limited to law enforcement that this is intended for. There was attempts to give some comfort that it would not be used for IRS purposes, but it will. I mean, it's certainly part of the goal of this was to stop money laundering and also tax evasion. So the IRS is going to get access to this information. And I have no doubt that whether pursuant to an amendment later or pursuant to the regulations that are issued on this, that we will see non-U.S. tax authorities have the ability to get this information in the same way that non-U.S. law enforcement can, perhaps going to the IRS.
So that brings a good point. So once this is put into effect, we know there's going to be a slew of changes. There's going to be a lot of mistakes with this act, and there's going to be many updates throughout the years to correct and fix it, and you believe that maybe one of them to come.
I do. I believe that you're very right. There's going to be quite a bit of work to clean up this process once it goes into effect. I don't think it's going to go smoothly at first. But, so much, the filing system, for instance, hasn't been conceived of to my knowledge. I mean, there's nothing in place that they plan on using unless they bolt onto an existing filing service, which I don't believe is anticipated. And so there's really no way to look up, well, how do I file this information? I mean, I know it's going to FinCEN, but, God only knows how you get it to them. Whether it's in a fast way, how long you have to wait until you can operate,
Can you go ahead and open a bank account before you have this number?
It's likely that this is anticipated that it would be before a bank account is obtained because it's expressly meant to allow banks to obtain that beneficial owner information under penalty of civil and criminal penalty to the filing party, so the bank can rely on that information. It is then, to my mind, sort of it's meant to be thought of as something that aids in the opening of that bank account.
Now, you say it aids perhaps in opening the bank account, but currently the IRS is taking a minimum of 45 business days to issue an EIN for a client that doesn't have a U.S. address and SSN. I wonder how long this potentially could take with the backlog and the initial filings. Hopefully it doesn't take the business, new businesses to a grinding halt.
Oh, yeah. I mean, and you figure that just on the day the act goes into effect, you have companies that have to file because they're newly formed. And then within 2 years, every existing company that's subject to this act, whether it files or not, will each have to file to be exempt. So it'll file substantively with beneficial owner information or claiming an exemption. It's going to be massive amounts of electronic submission.
So it's a massive amount of electronic. Now, currently, our IRS doesn't allow for non-U.S. clients that don't have the SSN and U.S. address to obtain an EIN number online. Mm-hmm. So this new act here, from what you're stating, is it's going to be able to be submitted electronically. It's not going to have to be faxed like these EIN applications for non-U.S. clients.
I believe that's correct. You know, the act itself refers to a filing system that's electronic. It refers to something, I think, for efficiency and recognizing that paper would just be, you know, a monster in itself in this context. But it's very possible that the regulations might have some sort of special case side systems that allow for paper reporting or may mandate paper reporting from certain persons. Yeah. Because, again, it's going to be coming from a ton of non-U.S. entities, not just U.S. entities, but U.S. entities that are registered to do business in a state. And you can only imagine how many of those there are that are subject to the act and registered to do business in a state. And think, too, of how grating it's going to be for, say, Italian, Indian, various persons all over the world to suddenly realize that by virtue of a subsidiary in the U.S., they suddenly have a filing obligation to give up their name, address, and passport info, birthday.
The beneficial owner, which they never had to do in the past.
Yeah, and they know the government is not claiming their birthday and other information to throw them a party. They're not coming with a cake. You know, the tax man cometh. He's not bringing you a present.
Well, I mean, I guess that leads to the next question is about if they don't do this, what are the consequences of failing to report it?
That's right. And so far, the regulations could do something here, or perhaps even provide for a administrative penalty of some sort, like an officer or director bar from a public company, which the SEC can do, for instance, bar you from being an officer or director in a public company. Something like that may be an option. Also, currently, a civil penalty of not more than $500 for each day that a violation continues is in the act. So a company that fails to report or that otherwise violates the act will incur $500 a day for as long as that violation continues. Now, for individuals, people at the reporting company and possibly people at the reporting company and perhaps beneficial owners that don't provide accurate information to the company. Because you have to think the company has to assume that it's getting accurate information from its own members and shareholders. I don't even know what the liability might be there for them being lied to. Is it a negligence standard, gross negligence? If they take all steps but they still are lied to, are they liable for bad information? But fines of up to $10,000 and possible imprisonment of up to 2 years for any person who willfully provides false beneficial ownership information or fails to provide or to update complete beneficial information to FinCEN. So, again, a small business, the fellow that bought a food truck and is now operating a taco food truck in a random city in Missouri is suddenly now going to have to consider his or her investors or else face possible imprisonment of up to 2 years for failing to properly file. Now, the Act in its analysis states that the burden on companies is very, very low. It's just a couple entries on a form. It's almost nothing. But given the open questions just that we've looked at today, the ambiguity and the confusion, I mean, certainly a business owner is going to hire an attorney or think they should hire an attorney to do this. And I would certainly counsel it. And they're going to face very significant penalties for this if they don't pay real attention to it. So I would say that the burden is much greater than the government and these agencies are letting on.
So you mentioned the burden on the small business, but really, in the big scope of things, is it really going to catch these bad apples? Okay, great, we've got a $10,000 fine, and if you're one of the people they're trying to catch within this large net they're casting, they're still going to provide this bogus information and just not care about a $10,000 fine. So really, what's the big purpose of this?
Yeah.
It's just to gather information about business owners?
It really is. It's to gather information purportedly about these bad actors. Again, the bad actors may provide false information and try to fly under the radar. I mean, if you've got millions of companies filing, it's going to be impossible for Treasury to audit this information on any real time or rotational basis. You know, millions of filers, they could simply put in, their crooked attorney's name, their brother's name, something like that, and escape what might otherwise be compromising information and evade the purpose of the Act.
Now, perhaps just hypothetically, we're talking about this. Now, if it were the Treasury and did realize that there is bogus information, they're going to be able to tie these back to different bank accounts, I would assume.
Quite possibly. I mean, they'll definitely be able to tie it back to whatever individuals are listed. They'll be able to tie it back to the formation information that they'll probably be given, the certificate of incorporation, the jurisdiction. But fundamentally, if you have a Panamanian entity with 3 intermediate entities from offshore jurisdictions, and then you have one beneficial owner who listed, it's going to be tough to discover an issue there, run it down, find that person, prove that they're not actually doing what they say they are, holding what they say they hold, or they're holding it on behalf of someone else. I mean, it really is just giving the government a massive database of information on business owners and businesses that, whether intentional or not, without getting too conspiratorial, which I like to do, but, I'm not going to do that here, my MK Ultra rant. But no, what it is it is a large volume of information that one has to ask whether there are not ulterior motives for collecting. Simply to have that much information about millions of businesses in the U.S. and outside the U.S. and about individuals doing business in any state from any state in the U.S. and from any country that applies under this law. I mean, it's to my mind, it's to gain the massive information and for international cred. It's to say that we are a white label, we are a gold standard country for AML, when the U.S. was really getting hit hard in the international community for being one of these countries that did not require a lot of information. But query whether this is really the answer.
Very good.
Well, I mean, Jarrod, you have brought up a lot of interesting information that I think a lot of people are going to find very interesting. We don't have too much more time left, so I'd like to see if we could dive into some questions here. And I'll bring up the question board here. And we'll go through a few of these questions that we have here from everybody. So, one, can you go back to list of who is excluded from who and must be reported?
Oh, sure. Go back in terms of to the exclusions of who's not a beneficial owner.
And again, this is recorded, so you can go back and look at this information. But just briefly, if you want to touch on that, on who
Could you read the question again? Could you go
He's
back
asking
to
who's
this?
excluded. They're asking
who's excluded.
So it's going to
Is it
be
companies or beneficial owners?
from the act who's excluded. So anyone more than 20 full-time employees in the U.S. filed in the previous year federal income tax returns in the United States demonstrating more than 5 million in gross assets or sales, and it has a physical office address in the U.S. must meet all three requirements.
So if you're an LLC or corporation and you have a physical office in the U.S., more than 20 employees, and you reported last year, I think it's 5 million or more in gross sales or revenues, you are exempt. That's the large filer exemption. And then
And the key is you must meet all three categories.
That's right, all three. And if you, for 1 year, do not, you're no longer exempt. You have to go to filing. And then if you say are exempt again the following year, then you can be exempt again. But you can fall in and out of this law. In terms of the regulated entity exception, if banks, credit unions, registered investment companies under the Investment Company Act, investment advisors registered under the Advisors Act, and probably exempt reporting advisors, broker-dealers, broker or dealer, nonprofit, certain accounting firms. There's a list of entities one can find. I gave probably about 2/3 here, but maybe more. But there are certain entities, and also the umbrella exception, an entity whose interests are owned only by one or more of the accepted entities. So if a bank is the sole owner, or three banks are the sole owners of your company, the sole beneficial owners, you don't need to report that company. But you would need to file an exemption saying we're not filing because the following three companies are exempt filers. And then each of those companies would have to make a filing saying why they're not filing. So you can see just the flood of paper and data bits we've got flying around.
All right, another question came from, can this information be used by immigration enforcement agencies?
That's a very, very good question. To my knowledge, it cannot, unless it has a law enforcement purpose, and it could fall into the law enforcement exemption. I don't specifically know about, say, immigration actions, being used to harass undocumented business owners and employees. I don't know. I would have to look at that specifically.
Okay.
From who has to be reported, who's not a beneficial owner. Essentially, it's easier in some ways to say who is. 25% of equity interests or substantial control over a company. There's certain exclusions, like I believe it was minors whose parents are reported, individuals acting as a nominee or a custodian, employees whose sole beneficial ownership is by title from being an employee of a company, an individual whose only interest is through right of inheritance, and generally creditors, unless creditors otherwise would be beneficial owners. Those are the companies people primarily excluded from beneficial owner if they otherwise fall within that 25% or substantial control test.
Okay. We do also have a few other questions here that came in prior to the webinar, but one person is a business owner of an online linen business of a parent company. The parent business is registered in Delaware. So she wants to know how this will affect the online boutique linen business.
I can't provide legal advice to any individual person, but I would say generally a business that is a subsidiary of another business has to look both to its own compliance and to the parent companies. And online businesses are definitely not excluded. If you are otherwise subject to this act, you will be subject to it. In a parent subsidiary context, if it's a wholly owned subsidiary, usually it would be the parent that would be reporting because the subsidiary, well, I guess you could say it would technically have to be both, but there will be some means of streamlining that. There will be some means of having one or the other make the dominant filing. But then still, you have to look at the parent companies.
Right. So there's a lot of variations there that would require an attorney to provide that information.
And even the attorney could only give you so much right now because the regulations haven't come out.
Right. All right. Well, I think this was a very interesting topic, and one that all of our clients will definitely find very interesting to watch at their leisure, and we'll certainly have more questions. I mean, if you guys have any questions, you can email us at sales@delawareinc.com or info@delawareinc.com, and we'll be happy to try and answer your questions to the best of our knowledge. Again, we're not attorneys, we're not accountants, so we can't provide you any legal or accounting advice. And all of the information that we presented here today is not to be taken as legal or accounting advice at all. But I thank you, Brett and Jarrod, very much for your time and presenting this information. And we'll keep our eyes and ears open for more information and keep all of our clients up to date as the information comes in. And maybe we'll do another webinar in the future down the road about this same topic as we really get into the nuts and bolts of the regulations and things of that nature. So appreciate everybody's time and listening to our webinar, and we hope you have a great day.
And it'll be up, I think, what you said, 24 hours or something. And will the slides be also part of that?
Yep, great. Yep. Great. Yep. Everything is recorded, and slides and all that will be part of it.
Fantastic. Thank you all.
Thank you.
Yep.